Hello, 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 and happy Thursday. Welcome back to yet another pop up live event where we unpack passive investing and multifamily underwriting one step at a time, one live event at a time. There are a few key headlines and topics that I want to cover today, mostly items that have surfaced through my one-on-one conversations with active and passive investors that I think are quite relevant in today's environment. But before we dive in, for those who may be tuning in for the first time or meeting me for the first time, my name is Vessi Kapulyan. I am a former commercial lender turned real estate investor, and today I help investors in two ways. For those looking to deploy capital, I connect them with well vetted cash flowing investments in apartments. And for those willing to and eager to learn how to underwrite deals, I help them learn how to vet and underwrite deals from beginning to end with confidence and ease. I also provide a second set of eyes, deal reviews, and work with investors on advising them throughout the deal investment process, the complexities of the structure, and all of that. So, if that's something you need, maybe you're not so much eager to learn how to do it, but you really need that second set of eyes. I'm happy to help you with that as well. But I wanted to cover a couple of topics and questions, and one is relevant because I'm getting a ton of inquiries, right, from investors on where is the next deal, what is happening in the markets, why are we not seeing all the deal flow that we thought we would be seeing based on the headlines of the beginning at the beginning of the year. And I've covered in prior lives the comments around the wall of maturities and a lot of the modifications, negotiations, and really uh, delaying, right? Or you may have heard the terminology extend and pretend. So I don't want to regurgitate this topic. But one interesting article that I came across earlier this week, published by Globe Street, notes that CRA market psychology narrows the bid ask spreads and speeds up transactions. So there are a couple of factors that are contributing to that. One is the recent decline in interest rates by 25 basis points, specifically the Fed funds rate. And I want to make a distinction here in the expectation that there will be another 50 basis points drop by the end of the year, which is pretty significant. And so, even though we've spoken at length, and you may have read at length about that upcoming wall maturity, a lot of people, at least those who can afford to wait, right? Not everyone has the capital and the balance sheet to wait, but at least those who can afford to wait are buying time, because now is the worst time to sell, right? For if you're an owner, the best time to buy if you're a buyer. But buyers are also subject to the current market environments, right? Which is higher costs to operate the property, softer rent growth, higher cost of capital based on where rates are. So they need to price the asset accordingly. Just because prices are down from the peak, and depending on which market you're in, that could be anywhere from 20 to 30 to 40%. That doesn't make a deal a great deal. It still needs to pencil out in terms of where the current market environment is. So what that has created is still a pretty significant bid ask spread between buyers and sellers, with sellers looking to at least exit if possible, right? At least break even, and ideally with some profit, but unable to do so because cap rates have been, I guess, back to more normal levels, right? We noted the cap rate compression that we experienced a couple of years ago, back in 21 and early 2022. And so really, I think oftentimes as I think through, well, what would it take, right, for these assets to trade, it's really one, buyers and sellers coming to term at a more normalized pricing, again for those who are already willing and able to still exit, at least break even and hopefully with some profit, or a really distressed situation where their credit facility is coming due and lender has exhausted all measures, right? They're not willing to extend anymore and there are no other refinance options, and or the lender maybe forcing the sale. That would be another sort of distress like situation. So with that said, I hear often also people sharing, oh, it's so hard to raise equity, but there are a number of reasons for that. And of course, the fact that CRE and multifamily, being part of CRE going through its winter season, that's not no secret to anyone. So there, over the past couple of years, so many deals have gone through foreclosures, capital calls, pulse distributions. Um, a number of Ponzi schemes, right, has been in the news lately. And so naturally, that's keeping a lot of investors also nervous and some of them on the sideline, coupled with the fact that deals haven't been penciled correctly. But beyond that, at least for the deals that were done a while back and about to come at their exit projected exit date, um, and or where perhaps operator is hoping to at least break even or provide a little bit more of a profit, right? And I talked about a real life example of that in my last live event. When that occurs, that will unlock, right, a lot more liquidity for those willing to continue to reinvest in commercial real estate. So part of the equity raising challenge is the fact that a lot of that equity is trapped, right, in properties. And I'm not going to say that all of it is, because if some of these properties were to be exited today, the investors will probably lose their capital, maybe not all of it, but a good chunk of it. But there are others who will probably at least break even. And so the timing of these transactions, or when these transactions start to take place, that will unlock a lot of equity that people will probably look to deploy, especially if they have any tax efficiency or tax um, additional tax concerns that so rolling forward the investment may mitigate some of those. So anyways, I thought that article was interesting and it spurred a lot of thoughts, but also brought back a lot of conversations that I've been having with investors around the deal flow and where we see things coming. My personal view is that at least based on the data today, I don't see cap rates collapsing back to the 3-4% levels. Will they compress? Maybe, but there are a lot of factors that will have to drive that. It's not just rates, right? And when we talk about rates, right, when the Fed lowers or increases rates, that's the Fed funds rates. A lot of these loans, specifically in multifamily, that have 5-7 year tenors, those are based on where the treasuries are, and specifically credit markets, mortgage markets. Those are driven by the long-term treasury rates. So the 10 year is a good benchmark that a lot of people are watching, and so that doesn't necessarily reflect only the economic conditions today, but also investors' outlook on where they see the economy going. And so there have been a number of factors and discussions around the persistence of inflation and potentially that further increasing, at least here in the US, but other locations as well. And so it was not surprising, right? When the Fed lowered rates last week, the Treasury prior to that had been inching around the 4 point mark, and then it ticked up to around, it's now 410, maybe 412 today, but slightly higher, basically, is my point. And that has to do, a lot has to do with those future inflation expectations. So all I'm trying to say is that those don't always go hand in hand. And if that's the index, right, index rate used to price loans, then investors typically, ideally, right, is at least in the stable value add space, will be looking to enter at least at neutral leverage. So when you add a traditional spread to that, you're looking around again, depending on the spread you're getting and the index and the tenor, but probably around 5.5 to 6%, 5.5 at best, but probably around six. So um, unless there is a massive value add, most buyers, right, wouldn't be looking to buy at a cap rate lower than that. Again, varies by market, and class A will probably have a slightly lower cap than a class C property. So I'm speaking in more general terms here. And so that's how I'm evaluating deals today as well, not necessarily with the expectation of cap rate compression, but at best assuming things will stay all else equal in terms of exit caps. And between that, the subdued rent growth, at least in the short term, the margins, right, of the deals that are out there is very thin. Again, you can change any number and make the deal look great on paper and show 20% IRR and whatnot, but that is not necessarily the point. So I hope this was helpful. Again, just wanted to pop up for a few minutes and share my thoughts and observations, but also address some of the questions that I've been getting lately with respect to deal flow, deal quality, rates, bid ask spreads, and all of the above. If you'd like to have a conversation further, feel free to connect with me one on one. I pop up once a week live on LinkedIn and YouTube. So if you'd like to be notified of future events, definitely follow me, subscribe to the YouTube channel, and that's how you get notified. And you also receive the recordings there as well, and will be able to access a ton of additional educational content that I have recorded and provided in that particular channel. So I really appreciate you. I appreciate you joining today, and I'll see you in the next one. Have a blessed Thursday. Ciao.